as usual, Buffett has said it the best, right? I feel like every week I discover something that I thought was so brilliant, but 25 years ago, Warren Buffett wrote about it. But he kind of said, look, the difference between a stock and a bond, essentially, for the investor, is a bond, the coupon's printed right on it. And the equity, you have to print the coupons yourself. That's the only difference. I mean, at the end of the day, the value of investment today is based on how much cash will be generated for the owner over the next 20 or 30 years, if you sort of discount it all back. If you can't have any reasonable estimate of what that's going to be, then you come back to that question: am I investing or am I speculating based on some other theory? And that's, I think, a lot of mistakes in the value investment community, if you want to call it that, fall into that trap of they get seduced by the upside. I remember going back to the oil and gas thing, a number of years ago I had invested in a small company that they had all these proven reserves. Some of them were developed, some of them were undeveloped, and they had an enormous amount of debt that they had taken on both to buy the reserves and to develop the infrastructure that they needed to drill the reserves, right? So like offshore drilling rigs and things of that nature. And the theory was, once this was all built out, they could start to really produce these reserves in mass, right? And then they'd be able to pay off the debt over time and whatever. But what you noticed over time was, as soon as one project was finished, they'd take on another project. And then that meant more debt, and that meant more pyramiding of debt up and up and up. And you sort of looked at it over time and you kind of ask yourself, has any value been created for the owner? Has any cash ever gotten to the owner of this company? And will it ever? And it's, you just kind of, if you can't answer that question with a high degree of probability, it's hard for me to say that's an investment, right? It might be a worthwhile speculation, but I told you this story before, and I'm going to repeat it because I always like that story that Charlie Munger used to tell, where he had this friend, and his friend said, I really learned a lot from my father when I was young. I stole candy from a store, and when I stole the candy, and my father found out, right? And I said, I'm going to give the candy back, Dad. I'm going to pay them. I'm just borrowing it. And the father said, you know what, son? You might as well just call yourself a thief every time you do it. You'll be better off. And it's almost the same thing with speculating. It's like, it's like Ben Graham said, it's not immoral, it's not wrong. Sometimes it can be profitable, but call yourself a speculator every time you're doing it. And that way you won't lose the distinction in your head, right? And you can sort of keep a certain purity around the investments you're making and around the speculations you're making. And if you want to make them, go right ahead. But just make sure you're being honest with yourself about it. Don't fool yourself. And I think that would help a lot of people, including me. I have to do this myself every time I make an investment. So.